So friends, let us try to understand the meaning of the capital expenditure, revenue expenditure, the deferred revenue expenditure, capital receipts, revenue receipts, etc. See, the classification of capital and revenue expenditures as such, it is based on the going concern assumption. The going concern assumption allows the accountant to classify the expenditure and the receipts as capital and revenue expenditure, as deferred revenue expenditure, as capital and revenue receipts. See, coming to the classification of expenditure, an expenditure may be classified as capital expenditure if it is an expenditure which is incurred to acquire or bring into existence an asset, or to acquire or bring into existence an advantage or benefit of an enduring nature, or an expenditure incurred to increase the productivity or the earning capacity of the organization. And any expenditure incurred on an asset or which is of capital nature, it normally yields the benefits beyond the current accounting period. And coming to the accounting treatment, it is debited to the respective asset accounting heads. Coming to the examples, the cost of land and building, cost of plant and machinery, cost of furniture and fixtures, vehicles, the cost of infrastructure, etc., etc. So it is shown under assets under the respective capital expenditure heads. Coming to revenue expenditure, it's an expenditure which is incurred to maintain the productivity or the earning capacity of a business. An expenditure which is incurred to carry out the operating activities in the normal course of business, to increase the productivity or the earning capacity of the organization. And coming to benefits, it normally does not yield any benefits beyond the current accounting period. And it is the expenditure is debited to the profit and loss account. Examples: the depreciation on land and building, rent of machines, the repairs of the buildings, the insurance of buildings, the pay and allowances of the employees, the TIDA, medical expenditure, expenditure on books and periodicals, on workshops, seminars, the fuel, maintenance of the plant and machinery, maintenance of the building, maintenance of the vehicles, the terminal benefits of the employees. These are all the examples for the revenue expenditure. Even the rent of machines, the repairs of the building. And coming to disclosure in the final financial statements, it is shown, it is disclosed in the income statement for the period ending on a particular date, preferably 31st March of every year. And it is, debited to the revenue expenditure under different revenue heads. Now let us see what is the deferred revenue expenditure. The deferred revenue expenditure, it is the expenditure for which the payment has been made or a liability has been incurred in advance, that is even before the happening of the event. So in short, it refers to that expenditure which is for the time being deferred from being charged to income. For example, the heavy advertising, expenditure on heavy advertising to launch a new product, it's a deferred revenue expenditure because the benefit from it will be availed over the next 3 years or 4, 5, 6, next 10 years and so on. So accounting treatment, normally such expenditure should be, it is shown under the deferred revenue expenditure heads. And normally such expenditure should be written off over a period of 3 to 5 years. And in the financial statements, it is again shown in the income statement. It is chart to income statement for the period ending on a particular date. And in the balance sheet also, under assets, under the deferred revenue expenditure, the unwritten portion of the deferred revenue expenditure should be taken to the balance sheet under assets. Now let us see the classification of some expenditure with reasons. The expenses, for example, on a foreign tour to purchase a machinery, so that is a capital. The insurance and freight on the machinery purchased, capital. Custom duty on the imported machinery, it is capital. The wages for erection of machinery, capital expenditure. The installation charges of a machinery purchased, yes, capital expenditure. The expenses incurred on trial before the asset is put to use, it is capital. The cost of a second-hand machinery purchased also is capital. The repair of a second-hand machinery before it is put to use, it is also capital expenditure. Interest on the term loan for the purchase of machinery, the commercial production has not begun till the last day of the accounting year, then it is capital. Interest on term loan for the purchase of machinery, the commercial production has already begun, means it is the revenue. The repairs of a machine after the machine is put to use, it is revenue. Amount spent for replacement of the worn out part of a machine, it is revenue. Annual maintenance fee of a machine, yes, it is revenue expenditure, whereas money is spent to reduce the working expenses. So that is the capital. So the amount spent for the replacement of, say, a petrol-driven engine by some other highly efficient machine or kits, it is capital expenditure because it is increasing the efficiency of its production efficiency because of this. And the cost of rings and pistons, say, of an engine, change it to get the fuel efficiency. It is capital because these are incurred to reduce the operating costs and thereby increasing the profit. The overhauling expenses for the engine of a motor car to get better fuel efficiency, it is capital. Legal expenses to acquire a building, it is capital expenditure. So these are incurred to acquire the ownership right, therefore it is capital. Whereas legal expenses to defend a suit claiming that, say, a firm's factory site belongs to the plaintiff, it is revenue because these are incurred to maintain the capital asset. The amount spent on repainting of an old building for the first time on purchase, it is capital. Amount spent on the annual repainting of the building periodically, it is revenue. Expenses to obtain a license for starting a factory, it is capital because it is required to acquire the right to carry out business. Similarly, the annual renewal fee of license for next year prepaid is revenue. Amount spent for the construction of temporary huts for storing the building material while the construction is on. So that is capital because these are incurred for the construction of the building. A deposit with Mahanagar Telephone Limited, it is for installing the telephone lines, capital because this amount is adjusted over a period of time against the telephone bills. Expenses for removal of stock to a new site, it is the revenue. And the fines imposed, always the revenue. The inauguration expenses on opening of a new branch, the free gift to the customers, or tournament sponsoring expenditure, advertisement campaigning to launch a new product. These are all revenue because such expenditure is not enhancing the value of the capital asset and it has no enduring effect on the future revenue generating capability of the business. But it may be treated as the deferred revenue expenses. And compensation for, say, the breach of contract, it is revenue. Compensation paid to the workers under voluntary retirement scheme, VRS scheme, it is the revenue. And say the amount, of course, it can be treated as a revenue expenditure, it may be written off over future years because you are paying that in advance. And the amount spent on the demolition of the building to construct a bigger building on the same site, it is capital. And the loss on the sale of machine, so it is revenue, but it is a loss of revenue. Legal expenses to recover the dues from the customers, it is revenue. Festival advance to the employees, it is not an expenditure, it's an item of loan and advances. So it can be considered as a deferred revenue, which appears under loans and advances. Advance to suppliers of goods, it is not an expenditure, it's an item of loan and advance. Cost of improvement in, say, the electrical wiring system, it is capital. The purchase of a patent right, it is certainly a capital expenditure because this is incurred to acquire the capital asset. And purchase of a goodwill, it is capital. Purchase of a technical know-how, capital. Purchase of a livestock by a farmer, it is capital. Amount spent on the new signboard at the airport, it is capital because this is incurred to acquire the capital asset. To increase, it also increases the revenue of the organization. The import duty on the purchase of materials, revenue. Compensation paid to the employees who are retrenched, it is revenue. Imported goods confiscated by the customs authorities, it is revenue loss. Such expenditure is neither bringing any enduring benefit nor enhancing the value of capital asset. Now, similarly, let us see the classification of receipts. The receipts, they may be classified as the capital receipts and the revenue receipts. See, capital receipts refer to those receipts which are not revenue in nature, and these are credited to the respective, the capital accounts, accounts of capital nature in the account. The examples are, for example, the sale of land and building by a person other than a dealer in the real estate. So if a dealer in the real estate, if he sells the land and building, it becomes revenue. So raising of loan by a person other than one engaged in the business of finance or banking, yes, it is capital. The raising of capital, it is also a capital receipt. And similarly, let us see the revenue receipts. The revenue receipts, they refer to those receipts which arise in the normal course of business. And these are credited to the trading or profit and loss account. The examples are, say, the sale of land and building by a dealer in the real estate, raising of loan by a person engaged in the business of finance or banking. Let's see classification of some receipts with the reasons. So the sale of plant and machinery, it is a capital receipt because it is arising from investing activities. And the sale of investments, capital, it is arising from the investing activities and not from operating activities. The capital introduced by the owner, it is capital. Loans raised, capital. Interest received on investment, it is, say, on your fixed deposits, etc., etc. It is only revenue receipt. And the interest accrued on the investment, it is revenue. Cash received from the debtors, it is revenue. And the bills receivables collected, it is revenue receipt. The sale of goods for cash, it is also a revenue receipt. Sale of goods on credit, also revenue receipt. Insurance claim for the stock damaged by the fire, it is revenue. Whereas the insurance claim for machinery damaged by fire, it is capital receipt. Subsidy received from the government for the purchase of a plot of land, capital. General subsidy received from the government to take care of the paid allowances and other revenue expenditure, it is a revenue receipt. The bad debt recovered, revenue. The scrap value of the machinery, it is capital. The premium received on the issue of shares, it is capital receipt. The bad debt recovered, it is revenue receipt. The scrap value of the machinery, capital. The premium received on the issue of shares, it is the capital receipt. So it is because it is arising from the financing activities and not from the operating activities in the normal course of business. So these are some of the examples for the expenditures and also the receipts. Thank you.